Okay, we're going to start. This is Paul Forrester, and welcome everybody to the Reverse Inquiries Workshop Series. And today's topic, as you know, is NAIC-related developments that are relevant to the structured investments community. We're delighted that you were able to join us today. We'd ask, however, that while you are on, unless you're asking a question, that you remain on mute, as we intend to leave a little time at the end of the webinar for questions that may be prompted by that. Obviously, if you have a question, please unmute yourselves to ask your question, or alternatively, if you prefer, you can always type your questions in the chat box. That's housekeeping out of the way. Let me introduce today's presenters. Joining me are Dan Favero. Dan is a real estate partner based in the Chicago office of Mayer Brown. He just waved. And he is a well-recognized expert in certainly in Mayer Brown and across the nation, actually, in credit tenant leases, which is what he will be speaking primarily to later in today's presentation. We are joined as well by Larry Hamilton, who is probably well known to most of you. Larry is co-head of our insurance regulatory practice at Mayer Brown, based in Chicago, but he has a 50-state regulatory practice, and that's why he's known to many of you. Last and least, Paul Forrester is speaking, and I am a finance partner in the Chicago office of Mayer Brown, and I work with Larry and Daniel on insurance-related investments. So with those introductions out of the way, in terms of housekeeping, Larry, could I call on you for a general overview of the NAIC regulatory structure, since it's a little peculiar to those who are not familiar with it?
Absolutely. Thank you, Paul. And I will just be very brief here. We have slides that cover this, and given the time constraints, I'm going to move pretty quickly through. But I think as most of you know, insurance is regulated primarily at the state level in the United States, unlike other countries. And we have the NAIC, the National Association of Insurance Commissioners, as a coordinating body among the 50 state insurance regulators. And one of the areas where they set standards is in the area of financial accounting and reporting. So the financial standard setting by the NAIC is under the jurisdiction of their Financial Condition, or E Committee, as it's sometimes called. And for today's purposes, we're going to focus on two subunits of that committee: the Statutory Accounting Principles Working Group, sometimes called the SAPWIG by way of acronym, which is responsible for statutory accounting guidance that is adopted, sometimes with changes, across the states, and the Valuation of Securities Task Force, which is focused on the credit evaluation process for securities owned by insurance companies. Another concept that originates with the NAIC is that of risk-based capital, or RBC, which is a tool the NAIC developed as a kind of early warning sign for insurers that have solvency issues. It's very formulaic, and it states a minimum amount of capital that the insurer has to maintain based on the risk, underwriting risk, and other risks that it is assuming. And there are capital charges associated with investment assets of insurance companies, which differ by the type of asset. And for fixed income securities, it's based on a designation, NAIC 1 as the highest, going down to 6, with the risk-based capital charge increasing dramatically as you go down the scale. For example, for a life insurer, an NAIC 1, essentially equivalent to an A corporate bond, gets a 40 basis point capital charge, and residential mortgage in good standing would be a 68 basis point. Private equity fund, just to look at the other end of the spectrum, 30%, 3,000 basis points. So bonds, how are they treated? And that's a generic term the NAIC uses for any fixed income type of investment. They get an RBC charge based on the NAIC designation, as I mentioned. And just to look, zeroing in on bonds, from that 40 basis point for an NAIC 1, you go to 130 for an NAIC 2, 460 for NAIC 3, 10% for NAIC 4, 23% for 5, and 30% equivalent to equity, in other words, for an NAIC 6. But how do bonds get their NAIC designations? That is the job of the Securities Valuation Office, or SVO, of the NAIC. They theoretically get to, if there were no external credit ratings, they would have to review every security and assign a designation. But they don't do that. Because of the need to expedite that process, there is a filing exemption for securities that have a rating from an external NAIC recognized credit rating provider. And if a bond is filing exempt, it just automatically gets the equivalent NAIC designation to that credit rating. So what do insurers care about? They want, number one, their fixed income investments to be treated as bonds, reported on Schedule D1 of their statutory financial statements, and get those lower RBC charges that we just talked about. And that is under the jurisdiction of whether they're bonds or not of the SAPWIG. Secondly, they want their fixed income investments to be filing exempt, to get that automatic NAIC designation corresponding to the NRSRO rating. And that is under the VOS task force and the SVO. So I again want to keep things moving. The NAIC recently has had a lot of concerns about focusing on two areas that we're going to discuss. One of those is the Valuation of Securities Task Force and its staff at the SVO concerned about whether external ratings are accurately measuring what they regard as the regulatory risks to insurers and their policyholders of these investments. And then the second one is the Statutory Accounting Principles, SAPWIG, questioning whether some types of investments that are in the form of bonds really deserve to be treated as bonds, or whether they should be treated as something other than bonds based on the underlying investments. And without going into the detail of that, I think we're just going to move quickly to slide 13, where life insurers have been seeking improved yields in a lower for longer interest rate environment, have been looking to get higher yielding investments without incurring punitive RBC charges, or even worse yet, have them not treated as fixed income investments. So this has led to some structures that some in the SVO staff regard as regulatory arbitrage, of cloaking one thing to look like another thing and therefore getting a better regulatory treatment. And there was came to a head in 2019. The summer for life insurers went into rehabilitation and insolvency proceeding after having made extensive use of principal protected notes. And at that point, the SVO really made their move and made a request to the VOS task force to actually change the treatment of principal protected notes and remove the filing exemption. And that has then led to all the other things we're going to talk about securities. So I'll turn it back to Paul to talk about briefly principles protected securities, but then also the new focus on so-called bespoke securities with the SVO and the VOSTF.
Thanks, Larry. And as Larry noted, we're not going to revisit the principal protected securities rules in any detail. They were finalized in May, and we'd certainly refer you for more detail and a discussion about them to our earlier webinar in May that went through them. Although I would like to, again, just for completeness, note that one of the, quote, deals, unquote, that was done as part of the adoption of these amendments was a very long transition period because there was no available grandfathering. And so the new rules only become effective for 2021 reporting. And we continue to see questions from clients and others as to the treatment of certain investments. And again, I would remind you that the definition that was adopted is somewhat awkward. And in particular, there's an interplay between the language of the definition and some examples, which may or may not correlate to actual investments. And one key question that we continue to see is how close to an example do you have to be before you're brought back into the definition when you might otherwise have escaped it. But again, just to remind you all that that change was adopted and is effective for 2021 reporting. So moving to, and I apologize, I'm going to quickly go through slides, which will be available to you, and we're going to post them on the web as well as send them to you following today's webinar. This is going a little slow. Okay, Bespoke Securities. This is a long-standing issue, and obviously in its most recent iteration really dates back to the great financial crisis of 2008 and 2009, which certainly exposed, I don't think anyone would argue, weaknesses in third-party ratings being provided by nationally recognized statistical rating organizations, or as they're known in NAIC speak, CRPs, credit rating providers. And in 2014, there was a reasonably developed and significant effort to address what was seen as the weaknesses in CRP ratings. It seems to have stalled, but it certainly was revisited, as Larry described, primarily as a result of concerns about regulatory arbitrage, and in particular private letter ratings, and private letter ratings not necessarily reflecting the investment risks that the NAIC and SVO in particular thought may be at issue. That culminated in May of this year when the VOSTF exposed for comment an issue paper, which had been written by the NAIC IAO, which is a combination of the SVO and the Structured Securities Group. And they expressed concerns about, quote, bespoke, unquote, securities, a term which was used for the first time, I think, by the NAIC in that issue paper. But it included two concerns, which were then elaborated upon in an educational session. The bespoke securities were defined as financial instruments typically constructed by or for a small group of investors, private, not subject to market forces, and visible characteristics may substantially underrepresent actual risks. So something quite similar to the principal protected concerns, but again, a little broader and more general. And certainly the concern of the staff focused on what they believe was the NAIC's current excessive reliance on CRP ratings, and concerns that those CRP ratings, were not properly capturing investment risk for statutory regulatory purposes. So clearly within the wheelhouse of the NAIC and the VOSTF. The draft issue paper, the issue paper, it was not a draft, the issue paper identified several indicators as evidence of a bespoke security, and we'll visit some of the low thresholds that they proposed. One, a single CRP rating, a private letter rating, assets that backed the security were primarily owned by the insurance company or affiliates before the transaction and were subject to different reporting, clear evidence they thought of regulatory arbitrage. Assets backing the security do not exhibit bond-like cash flows, again, which they regard as contractual requirements to pay periodic principal and interest. And the insurer or members of its affiliated group are the sole investors in the security offering. And last but not least, an affiliate of the insurer was the effective underwriter or sponsor of the securities. So they saw those six things as red flags and evidence or indicators of a bespoke security. Sorry, I went too far. The treatment that was proposed, again, would have started in 2021. It would have required the SVO to review all legal agreements underlying a bespoke security, and then to make a decision about whether the CRP rating was acceptable for the purposes of the NAIC designation and risk-based capital requirements, or whether it had to be filed to the SVO for an SVO designation. And obviously the analysis supporting that private letter rating would also have had to be submitted on an annual basis, and the SVO had the authority or sought the authority to determine whether or not the private rating would be allowed to continue or to be relied upon, or whether the security would have to be filed. At least two independent CRP ratings would have been required excuse me, I misspoke. If you have two CRP ratings for any NAIC designation, the lower of the ratings would apply, and they had some technical rules about that. So again, this draft issue paper issued in May was being discussed and reviewed by the Valuation of Securities Task Force, and ultimately received attention later in the year. The comment period formally ended in August, and there were comment letters written from both life insurance and P&C insurance trade associations, generally supportive of the idea that there may be these concerns, but critical of the low thresholds of the indicators that the IAO had identified. Significantly, in September, the parent Financial Condition E Committee sent a letter to the VOSTF publicly disagreeing with some of the comment letters and certainly declaring that the SVO did in fact have the ability to decide on a deal-by-deal basis whether to recognize a credit rating provider for filing an exemption or not. Most recently, advanced materials for a November 18 meeting of the VOSTF included a copy of the earlier report, as well as the other materials which described this concern generally. And everything at that point seemed to clearly indicate that the VOSTF was poised to make another step to narrow the use of filing exemption for bespoke securities. And maybe I should turn this to Larry now to describe what happened at that meeting.
Thank you, Paul. This is the fun part. So the gathering took place on November 18th, meeting of the VOS task force, and the SVO came in with its recommendation that was posted a short while, a few period of time before that meeting. They decided to zero in on one of the 6 red flags that they had identified, namely the private letter ruling, private letter rating securities, and their proposal was twofold. One is that when private letter rating securities are filed with the SVO, the rationale report issued by the rating agency would need to be filed along with it to provide the in-depth analysis and to show the methodology and how the rating was arrived at so that the SVO could look at that. Second, the SVO recommended that they be given full discretion based on their review of those materials to decide one of 3 things: that the private letter rating will determine the NAIC designation, or they will ignore that rating and instead do a full review at the SVO, or even say there will be no NAIC designation, which would be the worst alternative if you cannot get a designation that allows this to have a capital efficient RBC associated with it. So that's what was coming in at the meeting. What did the task force do? This was vigorously debated. The industry participants were, as Paul had said earlier, supportive of more transparency, but very opposed to drastic actions that would change the way investments were being treated. And the task force itself decided that they agreed with proposal 1. Let's get the transparency by requiring the private letter rationale to be filed with the SVO so they can see how these private letter ratings are being determined. But we are not ready to say at this point that the SVO gets to be the gatekeeper and have the discretion of whether or not private letter ratings will determine the NAIC designation or not. Let's get a report from the SVO based on their study of the rating rationales that they're seeing, and then decide. So it was, the first attempt was even to suggest exposing both approaches for comment, the transparency only and the transparency plus discretion. The task force, which are the commissioners and their representatives who actually sit on the task force, and they are distinct from the staff at the SVO. They said, no, we're just going to expose the idea of part 1 here. And so it was, in a sense, putting the brakes on this going, dramatically changing things, but at least paving the way for more understanding and information. So what lies ahead? If the SVO is able, based on their review of the rationales, to point to specific problematic issues, if they see clusters of issues that they can say, aha, this is introducing risks that we think need to be reflected and that aren't reflected in the rating, then part 2 could well be taken up by the Valuation of Securities Task Force in the future. And indeed, the SVO has already said it wants to schedule a regulator-only call, meaning a meeting of the task force that folks like us don't get to listen in on, in early 2021 to show their examples of what they think might be problematic. They don't think it should be eligible for the filing exemption. And depending on what they're able to show the task force and how the task force is moved by that presentation, you could see action coming out of that. So it's not clear at this point what exactly will happen, but we do know that the task force wants to see some evidence coming out of the transparency before they give the SVO the machete to come at a private letter rating securities that was being asked for. And that just reemphasizes the point I've made before, but it's really important, is the SVO, they're not the deciders. They are the staff. They work for the NAIC. The NAIC consists of the commissioners, and they're the ones who sit on the task force and also on the SAP working group that we're about to shift our conversation to. And they're taking a position on behalf of the regulators that is ultimately definitive. So we have to watch what they do and how they're thinking about these things. So back to Paul, we're shifting to that other group I said was very important for us, the Statutory Accounting Principles Working Group. And will they change the rules on structured securities?
Thanks, Larry. Yes, this is an interesting initiative and had as its origin concerns about regulatory arbitrage in a number of transactions, but certainly centrally in the minds of the SVO were concerns about collateralized fund obligation transactions, which were showing up in the marketplace. And we'll talk about that as well. So what did we do? In March of this year, the SAPWG exposed for comment a preliminary and only partial draft of an issue paper on potential changes to SSAP 43R, which is for loan-backed and structured securities. As I think many of you know, the process at the NAIC is always to prepare an issue paper which describes the issue, analyzes comments that are received on the issue papers. It's part of its consultation, and then adopt recommendations. And then there's a second phase, which is actually implementing the changes. So, but we're at this very preliminary stage, and again, only a draft issue paper. It questioned whether certain types of structured securities that were not within the SEC definition of asset-backed securities, so again, CFOs were top of mind, should in fact be within the scope of SSAP 43R, and as a result be receiving bond treatment, again, reminding you of Larry's earlier remarks about the importance of that. The draft issue paper generally proposed a narrowing of the definition of structured securities that were eligible for SSAP 43R treatment, and in particular would have probably had significant consequences to the investment portfolios of some life insurance companies. And as a result, the industry really resisted and protested vigorously to the point where a consortium of life insurers and their trade group submitted a 67-page comment letter before the comment period on the exposed partial draft expired in July. As I mentioned, there were 4 principles in the draft issue paper, which they saw as being necessary for bond treatment under SSAP 43R. Firstly, that there was a securitization, an issuance of debt securities from a trust SPV that was separate and distinct, as well as bankruptcy remote. Assets that were held in the trust SPV predominantly represented contractual obligation to make payments. Again, bond-like cash flows, a phrase to which we'll return shortly. The contractual payments to make payments were owed by many diverse payers. And last but not least, the securitization would distribute periodic performance reports to investors that would include information about the underlying collateral, its credit quality, and performance. The SAPWG met in October, and obviously the planned agenda for that meeting was to discuss the comments that had been received on the draft issue paper. And instead, the focus shifted to a proposal from Iowa. And at this point, I should turn the call to Larry to describe what Iowa proposed and why that may be a path forward.
Right. Thanks, Paul. The Iowa proposal, which the Iowa representative is Carrie Mears, who's a very experienced investment analyst and is highly respected within the NAIC community because of the fact that she does have an investment background. And she and her colleague proposed a principles-based definition for assets to qualify for Schedule D1 treatment. Interestingly, they said, we're not going to worry so much about whether it's SSAP 26R, which is captioned bond, or SSAP 43R, which is captioned loan-backed structured securities, let's just focus on what we all know the end goal is, which is bond treatment, Schedule D1, regardless of which of those two SSAPs it's running through. And so their proposal was that bonds would be defined as any securities representing a creditor relationship whereby there's a fixed schedule for one or more future payments and which qualify as either issuer obligations or asset-backed securities. Next slide, please. The issuer obligations, that's the easier one, debts of operating entities that are not designed to be a pass-through of other investment proceeds. So there's a list there on the slide: U.S. Treasury, government agency securities, munis, corporate bonds, convertible bonds, and bank loans issued directly by an insurance company or acquired through a participation or a syndication or assignment. So the focus, though, is on the asset-backed side of the house, and the definition proposed by Iowa for that is asset-backed securities represent debt issued through the securitization of financial assets. And the two qualifications that they propose to meet that are, one, that the financial assets collateralizing the debt issuance are expected to be the primary source of cash flows for repayment, and two, the securitization of the financial assets collateralizing the debt issuance redistributes the credit risk of the underlying financial assets. This is the key. Redistribution of the credit risk of the underlying financial assets so the creditor is in a different position than if it held the underlying collateral directly. So the over-collateralization that redistributes the credit risk is the key. And the proposal went on to say that although typically ABS are issued out of a trust or SPV, that is not the definitive criterion. Inherent in the definition of a bond is the creditor has the senior interest in the assets of the issuer for these asset-backed securities. The most subordinated interest, sometimes called the first loss position, sometimes even colloquially the equity piece, would represent the interest of an equity holder rather than a creditor, would never receive bond treatment under this. So there has to be a more than insignificant subordinated interest to be present for the senior interest to get the bond treatment. So the interesting thing about this proposal is it uses a very critical term, financial assets, as to describe the underlying, but it doesn't define that. And I actually asked that question of the proposer, and the answer was that we didn't define that. That's up for discussion. Significantly, it is not taking the phrase out of the issue paper, the draft issue paper, that it had to be bond-like cash flows. So potentially it could be broader than that. But how this gets defined is going to be critical. And so just want to mention that the comment period for this proposal ended on December 4th. We haven't yet seen what the comments are, but I'm sure will soon. But I found this Iowa proposal very encouraging because it shows that the regulators do listen to feedback and are looking to find a path forward that industry can live with. Paul, you may want to comment some more on this aspect too.
Yes, if I might just add, this is a particularly difficult legal area. There are actually 3 separate places where this same type of thing are defined under the securities laws. Rule 3A7 has a concept which is itself called asset-backed securitization as a concept of financial assets. It's a relatively broad concept, although it may or may not include leases, for example. Similarly, Reg AB has a definition, although that definition is a little narrower. It speaks about self-liquidating financial assets. And the Exchange Act, actually as a result of Dodd-Frank amendments, now also includes an asset-backed security definition, which has a list of specifically included things and then has a catch-all, such other things as the SEC decides should be asset-backed securities. But candidly, all 3 definitions really don't correlate that closely to market understandings and conventions. We call a lot of things ABS that do not meet those SEC security law definitions. So this is an important space to watch. And again, we don't know what comments were received on the Iowa proposal. Also, I emphasize, as Larry noted, This is principles-based, so essentially it may head us in a direction, but still to be done is the important and difficult work of defining financial assets that qualify for bond-like treatment. And a key issue will be whether they must include bond-like cash flows, and if so, what bond-like cash flows. And just circling back to the concerns that gave rise to this initiative, CFOs clearly can be repackaged. You can tranche a portfolio of private equity and other LP fund type interests. And the rating agencies, the NRSROs or CRPs, would certainly say a substantial portion of the obligations to be issued back by that portfolio exhibit bond-like ratable cash flows. And obviously the key issue will be how and to what extent the SVO disagrees or is able to make a case that the CRP ratings don't adequately reflect investment risk and so on. So I think we've headed in a more positive direction for the reasons that Larry articulated, but I just want to make sure everybody understands there's significant work to be done before anybody will have any real clarity about where this initiative is heading. So with that concluding the remarks about structured securities, I'm delighted now to introduce Daniel Favero, who's going to talk about non-conforming credit tenant leases and rated residuals. Dan.
Yeah, well, thanks, Paul. I put in this phrase, non-conforming credit tenant leases versus rated residuals, because many market participants don't like the term non-conforming credit tenant lease because the idea is that it's not a credit tenant lease at all. It's a separate type of investment. But to get to the difference between the two, I'm going to give it a little background and how we got to where we are. And what's happening right now, there's a discussion with SAPWEG, and it's going to be voted on again this Friday as to how to treat the so-called non-conforming credit tenant leases. And this all touches on many of the things that Paul and Larry have been talking about so far, you know, including the 43R initiative, which basically is going to determine what is a bond and how it should be treated. This maybe distrust of rating agencies that the NAIC has, and then of course the RBC factors and how risk-based capital requirements are fed into this whole equation. Credit tenant leases, as many of you probably know, are real estate lease transactions with a strong credit tenant as the tenant party. The lease is assigned to the lender as collateral. The lease rental payments service the debt. It's a long-term obligation. It performs like a bond, so it has predictable cash flows. And hence, it's been, for the last 25 years, has been treated as a bond for risk-based capital purposes, and it's recorded on 43R and Schedule D. About, I would say 6, 7 years ago, a new kind of asset class arose called Brownlees Financing that was structured very similarly to credit tenant leases. However, the source of repayment was not a credit tenant, but it would be a building with many tenants, perhaps an office building, hotel, other type of facility that would generate cash flow to pay the ground rent. The NAIC, and what happened was certain investors who were credit tenant lease investors also were investing in ground lease financing. Because there's no credit tenant involved in a ground lease financing, there's no rated entity. However, the NAIC Purposes and Procedures Manual provided that if you had a bond and it was rated, privately rated, it would be filing exempt. So many investors and other market participants, placement agents and investment bankers started structuring ground lease financings, and they would get a private rating and it would be booked as filing exempt. This went on for a good number of years, I would say 4, 5, 6 years. And then it came to light at the NAIC that this sort of market had developed. And because of partly their distrust of the rating agencies and the initiative to look at that, they started looking at the ground lease financing structures. And what happened is after a couple of year discussion with industry, a new asset class was added to the Purposes and Procedures Manual. So starting January 1st of 2020, there's a new asset class called Brownlees Financing. And if you look at that part of the manual, basically what it says is if you have a deal that's structured, meets all the criteria for a credit tenant lease, except that it doesn't have a credit tenant, those types of investments could be submitted to the NAIC, SVO, the Securities Valuation Office of the SVO. They would get a designation from the SVO, and it would be booked based on that designation. After that process of coming up with the Brownlees financing structure for the manual, it was agreed that the next thing that the SVO would look at would be the so-called non-conforming credit tenant lease. And so starting at the beginning of this year, 2020, various market participants and industry groups have been working with the NAIC to determine how to treat a non-conforming credit tenant lease. So the reason it's called a non-conforming credit tenant lease is typically one of the criteria for a credit tenant lease is that when you get to the end of the lease term and the maturity date of your loan, you can't have more than a 5% balloon, 5% of the original loan amount. And so if you had larger than a 5% balloon, what market participants started doing was just like with ground lease financing. That's why I brought this into the discussion. They would take that balloon piece and have it rated. And the investors would then, of course, book it as a bond and have it rated, and it would be filing exempt. And again, the NAIC didn't quite like that idea because they thought some of the aspects of these types of investments had more of a real estate flavor than maybe a bond flavor. And so it's been under discussion as to how those are to be treated. At the fall meeting of SAPWIG this year, there was also a question about credit tenant leases, whether they should also be 43R. It was determined at the fall meeting that the NAIC is going to leave credit tenant leases where they are, that is in 43R, as basically treated as a bond, subject to, of course, this 43R project, which is likely to last at least a year, if not more, whereby the NAIC kind of, which is what had been alluded to earlier by Paul and Larry, basically looking at what constitutes a bond and how it should be treated, what schedule it should be on. And it was determined that credit tenant leases, yes, they have bond-like characteristics. We'll keep them on 43R and Schedule D. Again, subject to the results of this overhaul of 43R. However, at that fall meeting also, the SAPWIG had recommended that CTOs be treated as bonds on 43R, but non-conforming CTLs should be added to Schedule BA. Schedule BA is sort of a catch-all schedule for investments. But however, if they were put on Schedule BA, the risk-based capital treatment would be kind of punitive. I think the risk-based capital factor would be 30%, and that's the factor. I think the actual increase is more like 1,700 times what it would be if it was on Schedule D. So quite punitive for the investor who may have booked this as a bond and put it on their Schedule D. So that recommendation was not accepted. However, what was accepted was that if you had a non-conforming CTL, which would basically what we're talking about with a non-conforming CTL, is a CTL transaction that has a balloon piece that exceeds 5%. Also at the fall meeting, the NAIC had indicated that they would also look at that 5% limit. So perhaps that 5% limit for a conforming CTL could be increased, but there's been no particular determination about that. So for those that exceed the 5% limitation, what had been determined was that the NAIC wasn't saying exactly where they should go. Instead, each investor who was holding those kinds of securities should submit them to the NAIC to get a designation from the NAIC. So that has caused a little bit of concern amongst investors because they don't know what the methodology will be that will be applied to these investments. And plus the timing is difficult because the idea was they are to be submitted to the NAIC before the end of this year. So those that have multiple investments feel it's an administrative burden to gather the information they need to make their submittal. And then if they're not determined, if they are given a designation, then they would be put on Schedule D 43R. But if they weren't, they'd go on BA and incur that significant RBC penalty. This Friday is another SAPWIG meeting to basically reconsider exactly how that's going to work, and perhaps there would be a delay or other instructions given as to how the non-conforming CTOs are supposed to be recorded and dealt with. And various market participants are having discussions throughout this week with various recommendations. Mainly, I think the biggest recommendation is to delay the process so that people have time to consider what they should do. But we won't know that till Friday. Back to you, Paul. That's about the state of play right now with the non-conforming CTOs.
Thanks very much, Daniel. As this slide shows, we have posted some supplemental materials and I've linked them in the presentation. To the extent we've referred to them and you're interested in them, they're available to you. One question, which is an excellent question, and unfortunately I failed to address it, is are all 6 of the red flags that were identified in the IAO issue paper for Bespoke Securities necessary? The answer is no. In fact, any one of them would have been sufficient in and of itself to be the red flag under the issue paper proposal. So hopefully that was clear. Another question which I will tackle is from a practical standpoint, are the credit rating providers willing to share their private letter analysis with the SBO? That's an interesting question. I can only speak to my experience. My experience is for private letter ratings, you get a private letter rating letter, and that's the evidence of the CRP's analysis. However, having said that, the letter often refers to the methodology that was employed and used by the credit rating provider. And under other statutory and regulatory requirements, the CRPs, at least the NRSROs, meant to make available their methodologies on publicly available websites. As somebody who looks at them frequently will know, they're hard to find sometimes, particularly if you're looking for the latest statement on something. But again, they are required to publicly make them available. So I can't imagine why they would refuse, but currently their practice is not to provide the recipient of private letter ratings with copies of the underlying methodology that they used. So I see Melissa has also included in the chat links to the supplementary materials. I didn't see any other question. It looks like we have one though from Amit. Amit.
Yeah. Hi, Paul. How are you? This is Amit. Yeah, that's from UBS. You can hear me well?
I can. Okay, thank you.
Perfect. Thank you. Thanks for the list of red flags. This is very helpful. The question I wanted to ask is, if we were to satisfy pretty much everything but have a single rating from a rating agency, how steep of a uphill battle do you think we may be facing for that?
I'd be very interested in Larry's views, so I'll ask him to respond as well. But I think my view is that, a single credit rating provider rating really isn't indicative of anything other than, one rating was enough. And it isn't evidence or indicative, at least in my mind, of the regulatory arbitrage or the non-market exposure or a lot of the other things that were identified in other red flags. So if you can not have any of the other red flags present and your only red flag is a single credit rating provider rating, that seems to me to be a pretty low risk transaction. Again, recognizing that the real core concerns were ratings not properly reflecting investment risk and not being exposed to market, and regulatory arbitrage and taking existing assets on a balance sheet and repapering them in some way. That was really the heart of the proposal, I think. But that's my personal view. Larry, do you have anything to add?
I don't have a different view, Paul, and I would just like also to take a moment. I skipped some parts of our slides because I wanted to make sure we had enough time for everyone to present and for questions at the end. But I do also, as an insurance regulatory lawyer, I deal with the regulators and I deal with the NAIC staff regularly. And they are uniformly, at the NAIC staff, I want to say, just very terrific and open people and answering questions and being helpful in every way, I have found. And I just want to put in a plug for the idea of insurance regulation, which is, the purpose of it is to protect the policyholders. Insurance companies make promises to policyholders, and the regulator's job is to make sure that those promises are kept. At the same time, the industry is very vocal in saying, we have the same goal. We want to keep those promises to policyholders. And one of the reasons we're concerned in the low yield environment is to make sure, particularly in the life insurance area, that we have the ability to keep these long-term promises in the current environment. But regulators are necessarily going to look at investment risk differently. And the example I use in the slide is, anytime you've ever seen a disclosure document for a public or private offering, it has warnings in there that say, if you make this investment, you need to be prepared to lose some or all of your investment. But did you ever see an insurance policy that said to the policyholder, if you buy this policy and pay your premiums, you need to be prepared that we'll lose that money and you won't get your claims paid? No, that's unthinkable. And so regulators just have a different view of risk, because their job, and it's important work, it's even holy work, I will say, is to make sure that that doesn't happen, or that if it happens with enormous infrequency. And so I hope that nothing I've said suggests any kind of enmity relationship with the folks at the staff of the SVO and the staff that work for the Statutory Accounting Principles Working Group, who are really working with one goal in mind, and that is the protection of policyholders. So I have to say that. So now you can throw the tomatoes at me, but that's also where I'm coming from, and why we're educating here. I think hopefully it's an education that flows in both directions as to what the rationale of regulation is, and also how to help industry participants to do their job of succeeding in keeping promises to policyholders. So that's my soapbox, but thank you for indulging me a bit on that.
While we're waiting for another question, I would just echo what Larry. Oh, sorry, Ahmed. I would just echo what Larry said, although my perspective is a little bit different, as you might imagine. I do see evidence that the SVO may not fully understand some of the investment products that they're looking at. And in particular, I would note the furor that was raised last year when the NAIC issued a relatively critical report about CLOs, and clearly used analysis that investment analysts were very critical of as being overly conservative. And so I do think Larry's point about making sure communication is two-way is a very important one. They need to understand how these investments work. They need to understand why rating methodology is properly reflecting and capturing investment risk. And we need to be able to help them do their job. And if that means people like Ahmed go in and talk to them and explain how deals work, that's a good thing. And I know he's done that, so I'm calling him out. But again, I do think Larry's point is right, that you do have the ability to approach regulators. I think our experience, and Larry's in particular, has been they're very helpful usually. And again, often it's a misunderstanding or not fully comprehending, how the analysis and methodology actually works. And we need to do a better job as an industry group in doing that. So anyhow, that's my soapbox. Anybody else have any questions that we might address today?
Do you mind if I ask another one? This is
No.
Ahmed again. Sorry, I don't want to.
The forum is yours.
Okay. So I keep hearing this concern around rating agencies' analysis not capturing all the investment risks associated with a certain product, which makes a ton of sense, obviously. But have they talked about the types of risks that are not addressed for, the CFO product, for example? Were they specific around their concerns?
Larry, again, has a more educated view and will respond. I think the short answer is only sort of. I mean, we know they were concerned about CFOs, but remember what their concern was. Insurance companies were taking existing portfolios of private equity or other LP fund interests, selling them to an SPV in a true sale, and then taking back essentially all of the same securities issued by the SPV, but instead of taking a 30% up RBC charge, they were taking a much smaller risk-based capital charge because of the ratings that were assigned to the senior bonds. There are two arguments about that, two views you might take of that. One is, they haven't changed their position, so why are they getting a different risk-based capital treatment? They hold exactly the same aggregate investment exposure. The contrary argument is, well, they really haven't. They've repapered their transaction. They have the ability to sell bonds. They have the ability to sell equity. And obviously the equity is supporting and available as the first loss piece to support the payment on the other notes. So there is, in fact, a difference that's been introduced. Clearly, you've got a much stronger argument if you actually sold some of the securities. But again, conceptually, those are the two viewpoints. I think, as Larry noted in his initial remarks, one of the things that really has been behind this is the regulatory arbitrage that was evident in the rehabilitation in 2019. It was particularly egregious. The company in that case was taking affiliate investments, which should never have been in an insurance company balance sheet, putting a zero coupon thing on them, and then bringing back the principal protected security into the insurance company balance sheets. And from a regulatory perspective, that just freaks them out. You've got non-admitted assets now being admitted or coming onto insurance company balance sheets. And so, the fact that they've reacted the way they have and they've been as hostile as they have, really, I think, it has that as its origin, at least in large part. I don't know, Larry, do you have things you want to say?
Nothing really to add other than to comment that the repackaging, where it's clear that the sole purpose is arbitrage, that you hold the same thing on day one and day two, and the treatment is radically different. It is clearly one of the things that is going to get the attention of regulators, because it seems like gaming the system in the regulatory view.
And I would add just non-exposure to markets. So again, if you have a transaction on it and you're willing to distribute a portion of the securities, that really should validate the fact that it's not just bookkeeping, it's actual, third-party investor, analysis and investment based on their analysis. And that really does legitimize a transaction that might otherwise, again, just be viewed as a repacking.
Right, yeah, exactly. And I think the case we have in mind is a true bona fide CFO structure that's used for raising permanent capital for a private equity asset manager, and not sourced by assets already sitting on insurance companies' balance sheets, and then will be distributed not just to insurance companies but other investors as well. So that's kind of the context that I was asking my questions around. And then also from a risk perspective, that's a tough area to understand. Obviously, rating agencies try to be as comprehensive as possible. They look at many things, quantitative and qualitative. But when you're faced with an argument saying that you may not be covering all the risks, that's such a tough argument to kind of defend, because they apply stress tests on many things that they can apply, and then nothing is perfect there. There are risks outstanding, but to the extent they're not being specific, I don't know how we can address that concern? I think is what I'm trying to
think the
get
protection, yeah, the protection is really twofold. One, it's educating, both the domestic commissioners so that, the people who actually first level regulate the insurance companies understand what they're doing, and they, have an appreciation for why the insurance company is making the investments of the type that it is, and that there really is a satisfaction and people are comfortable that in fact the ratings do reflect the investment risk. But the second discipline, I think, was evidenced, as Larry noted again in his remarks. The commissioners listen to their constituents, in this case, the insurance companies, and the insurance companies were pretty vocal about what they viewed as a potential regulatory reach and a potential unintended consequences of some of the SVO proposals. So there is certainly, not complete symmetry between the SVO view of the world and the views of the task force or working group in this case, or the NAIC more generally. There's plenty of evidence of that. Again, most recently on the proposal about Bespoke Securities, where the SVO went in with a very specific request and only got half of it.
Awesome. Thank you so much, Larry.
Welcome. Anyone else? We're just a couple of minutes from the designated hour. If not, why don't we close? Thank you very much for your attention. We appreciate that. And certainly if you have questions, we encourage you always to reach out to us. You know who we are. And again, you'll be seeing an email from us shortly with the slide deck and the links to the materials that we've referred to today. This concludes our presentation. You may all now disconnect. Have a great day.